Hi guys, welcome to another episode of Analyze This, where we basically get to touch on everything business, finance, and the economy. My name is Tunji Andrews, and with me on the show is my co-host.
I'm Arisa Ugu, and today we're going to be talking about insurance in Nigeria. So insurance is basically a hedge against risk. So you can get insurance on anything that is valuable to you. So from your car, your house, your laptop, your phone. But I find that in Nigeria, we tend to have this attitude towards insurance like, it go better, God forbid that will happen to me. But unfortunately, bad things happen to good people sometimes, and we need to have the attitude of preventing it before, it happens.
I remember this morning, I was going to work very early in the morning, like say maybe 5-ish, because I leave very early. And right in front of Quillox, I saw this, there was this fire, right? Two cars.
Wow.
There was this G-Wagon in front, and then a saloon car rear-ended it. I don't know what happened, but whatever it was, both cars were completely burnt beyond recognition. It was so bad I didn't even know what the saloon car was. And I was thinking to myself, I wasn't even thinking about the saloon car. I'm thinking, this G-Wagon, I hope it's insured. Because, I mean, at that point, he probably didn't have anything to do with that accident. And the car's gone up in flames. And he's thinking to himself, where am I going to get 25, 30 million to get this car again? Especially in the situation we are right now. And that is what insurance kind of does for you. So I'm thinking in the insurance, the financial world, the first thing any investment person is doing, or in fact,
hedging against
exactly,
risk.
We're always looking at risk. So we want to put money into stocks. We're thinking how possible is it for us to lose money? We're trying to put money into real estate. We're thinking how possible is it for us to lose money? And that sort of helps us drive how much we put into every investment. So I'm thinking to myself, how come is it that Nigerians walk about every day not thinking of the biggest investment they have themselves? So you're thinking, I will not fall ill because Jesus will not allow it. I will not die. It's not my time. I will live to declare the glory of the Lord.
But bad things happen, guys. Like you are your greatest asset. You need to protect yourself against risk because the cost is probably going to be higher in the long run if you don't have insurance. But let's go to the streets and see what the people are saying about insurance.
Insurance, I know it's a means of protection from financial loss. When I get a car, I'd love to insure my car.
Insurance is basically planning for the unknown, uncertainty that comes with life. That's it, basically. People are not really aware. It's something that they should take seriously because uncertainty is part of life. There are risks involved in everything we do. So from insuring your house to your car to properties you have, it's actually a very wise thing to do.
Insurance, to me, is to safeguard against loss and risk. That is basically what I know about insurance. Views on insurance. Actually, insurance is good, but Nigerians, the general view about insurance is wrong because when it comes to premium, they expect you to pay premium, but at the end, when the loss occurs, you have to go through stress before you can get your claim. So it's very, very ethical.
When you want to sell a policy to a customer, a client, let them know what it entails. Let them know how they can get their funds back in case of any eventuality. Basically, when you let people know what it entails, and they should make it a lot more simpler, easy, I'm sure many people would like to venture into it.
Yes, now. This guy is insured now. Third-party insurance, comprehensive insurance. Yes. Health, car, house. Yeah. I'm thinking of taking a life insurance.
People should be more enlightened about how important insurance is because it actually is. It actually is very important for people to have insurance. But due to the amount of workforce that we have in Nigeria and the amount people are being paid for their labor, I mean, how much do you have before you start insuring? Very little. You need to have something concrete to live on before you start thinking about insuring the rest.
And you kind of notice that most of the people on the streets are saying, you kind of get that they know what insurance is, but they're like, I think I
They're
have
very
on my
unsure.
car, I have third
Or I'm going to
party,
get.
I'm going to get. But really, I think that's a problem, and it's an issue with the insurance companies because the average person doesn't really get the entire crux of why he should have insurance. For instance, there's insurance against death. There's insurance against your child's education, for instance.
Yeah.
So if your child is going to school, there's insurance against you dying or being permanently disabled and not being able to earn any income again. So the insurance kind of kicks in and makes sure that your children's education are done till the end. Even as a tenant, imagine your house, as in all the things in your house. Imagine if you had to lose everything to a fire. God forbid. I mean, imagine if you had to lose it to a fire. You'd have to start again. Television costs about 2 times the price it used to be. I tried to buy air conditioning last week, and it's about two times the price. So imagine buying everything you bought before for double the price again. The question you're asking yourself is, why does the average person need insurance? Why does the person who has a shop in Alaba need insurance? Why does Ebano need insurance? Why do I need insurance? I mean, so I think if the insurance companies can go to, educate, and it's not just having shows and saying this product, it does this, it does that. You really need to touch the people's lives to explain to them in detail why. I mean, why exactly? I could die at any point. I mean, it's not really. We're all going to die someday. So it's important that you prepare for that time.
But you have, and especially if you have dependents, then you need life insurance. It should be mandatory.
So the more you have assets, the more you start thinking of, I need to prepare for anything happening.
And I think you could tell from the people on the streets that there was a lot of hesitation.
Yeah,
they don't have a lot of confidence that the insurance companies are going to actually pay the claims. And they feel like there's a lot of processes involved in getting their money back.
But can you blame them though?
Not really. But do you know what I think it is? I think that even if a few years ago they consolidated that industry, they recapitalized, so the whole point of that was so that we could have stronger insurance firms. But I think they still need to do some more consolidation because we still have, the industry is still very fragmented. So there are lots of small investment firms that don't have a big enough balance sheet. So those small, because basically the way it works is for an insurance company to be able to pay claims on time, they need to have a lot of premiums. And if they don't have enough premiums, they can't absorb the risk. So I think that we need to have enough companies who are merging so they have bigger balance sheets and are better able to absorb the risks.
Because, I mean, the thought is not everybody is going to claim at the same time.
And even with that, I think that the government shouldn't even just be leaving it to individuals to say, oh, I will get insurance. I think we need to make it mandatory. They need to set government policies that make it mandatory, just like the pension funds. Pension companies people were not contributing to their pensions until it became the law. Now the pension companies are one of the biggest investors in stock markets.
I'm telling you, they're the biggest indigenous investors we have anywhere, basically.
They have huge balance sheets, and everywhere around the world, insurance companies have one of the biggest investments possible. They own a big chunk of the stock market. They have property. They have assets. So the government needs to set policies that makes it mandatory for people to have car insurance, have health insurance, have life insurance. So they're deducting it from their salaries.
If deducting it from your salary is also kind of a savings for you because it's kind of tax exempt. So you really save a little bit on your taxes that you're paying. So, I mean, it does make a lot of sense. We're just giving you the tips on why. It makes too much sense to actually have insurance, life insurance, car insurance.
Also, and this is one of my biggest pet peeves. This is my feeling. I feel like the way insurance companies market themselves is very confusing. Right now, they have insurance products that almost compete with asset management firms and stockbroking firms. So it's like their target savings investments. So they'll say, bring 250,000 and every quarter we'll pay you this return on your investment. But shouldn't they be positioning themselves as, risk cushions for your property or your assets as opposed to investment products. I think they need to focus more on the core of their business and talk to people about why they need that safety net, and educate the lower part of the bottom of the pyramid. People need to understand, even if you're earning 25K as in a month, you can still take
maybe 2,000 or something out of it.
So I was talking to a friend of mine, and he was saying, do you know what? I have life insurance because, like, group life insurance, for example, you can pay 5,000 naira a month, and that gives you like a 1 million naira cover. And he says, do you know what? God forbid if my friend dies, what they're going to ask me to contribute is actually way more than that 5K. As in, so it's more cost effective in the long run if you have insurance. Breaking it down, insurance institutions, breaking it down to the average person, explaining why they need it and how cheap the premiums
can be on the long run. But I do want to speak for the insurance companies. I mean, I want to be on your side now. It's no. See, the thing is they're still very small. So because they don't have as many.
So they should merge.
Yeah. So right now they're still thinking, okay, let's give other offerings to be able to at least keep in business. Because I mean, if you're not going to buy insurance, you might want to save, and they feel, okay, let's give you a savings product. Although they shouldn't be doing that, like Aressa said, focus on your core skill. But it is what it is.
Yeah, I'm not saying it's wrong. I just don't agree with it. I think it's really confusing and, going away from their core business. So get insurance, guys, is really important. Thank you so much for watching this episode of Analyze This. To continue the conversation, the hashtag is Analyze This. The handle is @NdaniTV. And my handle is Smart Money Arisa.
And my handle is @Tunji Andrews. Till next time, guys.
Ladies and gentlemen, boys and girls, my name is Fowls, aka Fowls the Bad Guy. Well, in today's lesson, I will teach you how to subscribe to the Ndani TV channel. All you have to do is click on this. So simple, straightforward.
Hello everyone, I'm Lawrence Alexander, your automotive insider, and today I want to talk about GAP. Now I'm not referring to the space between Michael Strahan's teeth. GAP, or Guaranteed Asset Protection, is an insurance policy that covers the difference, or the gap, between what you owe back to a lender and what your insurance company will settle for in the event your vehicle is declared a total loss. Now you're probably thinking to yourself, I have full coverage insurance. Why would I need gap insurance? Most consumers are unaware that your insurance company is not required to pay off the balance you owe to a lender. They are merely required to pay the lowest actual cash value that they can find based upon a number of different variables and book values for the vehicle. Now, you ever thought you've been lowballed on your trade at a dealership or had negative equity? Imagine haggling with your insurance company who are desperately trying to pay you as little as possible for your wrecked pile of metal. Now, let's talk about how gap insurance actually works. You finance the vehicle and your balance is $25,000. Now, somewhere into the loan of that vehicle, you wreck your car and your insurance company totals it, but they say it's only worth $20,000. But wait a second, you still owe $23,000 to the lender. That's a gap of $3,000. Plus any deductibles you owe back to your insurance company. Without gap insurance, that's your responsibility. With gap insurance, you walk away clean and free. Now, not every individual needs gap insurance for every vehicle that they finance. However, there are a few situations or scenarios that can increase the need for gap insurance. And let's take a look at some of those examples. The first situation that can affect the need for gap is negative equity. Now, rolling a balance from a previous vehicle or trade-in can greatly increase the need for gap. Understand, your insurance company is only interested in the actual cash value of the current vehicle you're driving. The more money you roll over from another vehicle, the greater the need for gap insurance. The second situation that can affect the need for gap is your APR. Now, while lower APRs offer a decreased need for gap, understand that higher APRs offer a significantly increased need for gap insurance. The reason being that with high APRs, more and more money each month is going towards the finance charges, meaning less and less money each month is going towards the principal balance. If you total the vehicle, chances are you're gonna owe more money on it than it's worth. Another situation that can affect the need for gap insurance is money down. Now, if you're putting $10,000 down on a $20,000 vehicle, chances are you don't need gap insurance. However, if you're placing $0 down or very little money down, say just enough to cover your taxes or your fees, then you're at an increased need for gap because you are financing the full value of the vehicle, a vehicle that's going to depreciate the minute you drive it off the lot. Meaning if you total that vehicle, chances are you're going to owe more money on it than it's worth. Now, the fourth and final situation that can affect the need for gap insurance is your contract term. Now, while shorter terms or short-term financing offer a lower need for gap insurance, understand that long-term financing or extended term financing offers a highly increased need for gap insurance. Now, while longer terms offer lower monthly payments, that just means that less and less money each month is going to decrease the principal balance of the vehicle. Meaning if you total it, chances are you're gonna owe more money than the vehicle is worth. I'm Lawrence Alexander, your automotive insider. Hopefully the situations we've went over today provide you enough information to make an educated decision about your need for gap insurance on your next vehicle purchase.
Seven reasons to be wary of equity indexed universal life insurance. From Bank on Yourself. What if I told you there was a relatively new life insurance product that lets you share in a portion of the gains of the stock market in those years it goes up, but protects you from losses when the market goes down? Sounds pretty exciting, doesn't it? And what if I sweeten the deal by telling you that even in those years when the market tanks, you'll still get a guaranteed increase of 1, 2, or even 3%? You'd probably say, wow, where do I sign up? Well, hold on a minute. I've just described one of the most overhyped life insurance products around today, Equity Indexed Universal Life, or EIUL, also known as Indexed Universal Life. An Equity Indexed Universal Life policy is essentially an annually renewing term insurance policy with a cash account on the side. Now, term insurance policies get more expensive as you get older, until ultimately they become so costly that most people are forced to drop them. In an EIUL policy, the term insurance automatically renews every year at a higher rate. Wow, that can't be good. The reality is that equity-indexed universal life policies are ticking time bombs for many reasons. Here are 7 reasons to be wary. Reasons that advisors who push these policies often neglect to point out. Number 1, illustrated values. When it comes to predicting how well a policy might perform, EIUL policy projections make some assumptions that are remarkably optimistic and misleading. First, their interest rate predictions are based on the past performance of various stock market indexes, often focusing on a recent 20 to 30-year period. Remember, the last 30 years included the longest bull market in history. How likely do you think it is that that performance will repeat itself? And are you willing to bet your life savings on it? Agents who sell these policies will tell you the policies have a proven track record, but they've only been around for 15 years. So because they don't really have a lengthy track record, they'll tell you the EIUL policies have been back-tested to increase accuracy. So what does back-tested actually mean? Investopedia defines backtesting as a simulation based on past data. It then states, quote, "The results are highly dependent on the movements of the tested period. Backtesting assumes that what happened in the past will happen again in the future, and this assumption can cause potential risks for the strategy. As you'll frequently hear, past performance does not necessarily guarantee future returns." End quote. Second, illustrations for indexed universal life policies are further skewed by projecting a given average annual rate of return and then predicting you'll get that same rate every year for the life of the policy. How likely do you think it is that the market indexes will increase by the exact same percentage every year for 50 or more years? That's simply not going to happen. In addition, a policyholder's actual results can vary widely from what's shown on the illustration by as much as 100% or more. It depends on which indexing method is being used. Agents will typically show you interest crediting rates of 8% or more each year. Do you really think that just because they're showing you an illustration with a projected return of 8% every year, that you'll actually earn 8% in any year, let alone every year? The agent will tell you that you'll get a portion of the market's increase in any given year, but he may not tell you that the company can change how much of the market's increase you'll be allowed to share in at its discretion. While a promoter of indexed universal life policies can dangle pie-in-the-sky numbers in front of you and tell you, "These are the returns I bet we can get for you," in contrast, bank-on-yourself type dividend-paying whole life policy projections must, by law, predict future growth at a rate that is no higher than the current dividend scale. Furthermore, your cash value in a dividend-paying whole life policy is guaranteed to increase by a larger dollar amount each year that the premium is paid. The second reason EIUL is a ticking time bomb is costs. The costs for insurance and administrative charges are deducted from an EIUL policy's values every month. These costs can include insurance charges, policy charges, transaction charges, policy issue charges, premium charges, and costs for additional riders. This is different from a whole life policy, where all costs have already been deducted from both your guaranteed and projected results. All insurance policies have costs that the policy owner pays, but an EIUL insurance contract states that when those costs go up for the company, they can pass them on to you, the policy owner, up to some maximum limit. Bank-on-yourself type policies can never pass more costs on to you. EIUL agents will often show you projections based on the current charges, not the maximum charges you could end up paying. Some people call this lowballing. On one EIUL illustration we saw recently, the insurance company credited a very generous 3% annual guarantee, and the illustration assumed that the charges would be the maximum allowed. What happened? The illustration showed that the cash value of that policy was guaranteed to go to zero in the 15th year. Heck, I can make my money disappear today just by handing my wallet over to my 14-year-old niece at the mall. Why wait 15 years? But what if the assumptions were a little less drastic? What if middle-of-the-road variables were used instead? Say an annual interest credit of 5.72% per year and middle-of-the-road costs every year. That forecast came out much better. It would take 20 years for the policy to have zero cash value. True, if you consistently pay EIUL premiums at the highest allowable premium level, your costs probably will not increase dramatically, but you still won't have any idea what your cash values will be. The third reason to be wary has to do with the guarantees on EIUL policies. Some policies offer an interest rate guarantee of 1, 2, or even 3% per year to offset years when the market goes down or is flat. And the illustrations reflect that. However, most policies don't actually credit the guaranteed interest to your policy every year. They may do it only every 5 to 10 years, or very commonly, only when the policy is terminated. So the illustration is pure fiction. Meanwhile, all the costs are still coming out every month, which means your policy will lose value in years the market goes down or sideways. And it may even lose value in the years when the market goes up by just a little. You then need even higher future returns to make up for that negative return. Did your EIUL agent warn you about that? It's entirely possible that you could pay premiums every year and end up with no cash value and no death benefit if the stock market indexes used don't perform as projected. Another EIUL policy illustration we've seen clearly states, quote, based on policy guarantees, the cash values are 0 at age 100, unquote. Of course, that disclosure is in very small print, but can you imagine paying premiums for decades and having 0 cash value? That is so different from a bank-on-yourself type policy. With a bank-on-yourself whole life policy, everything except the dividend is known, guaranteed, and determined in advance. Your cash value is guaranteed to equal your death benefit when the policy matures. To find out how big your nest egg could grow, guaranteed and predictably every year, if you added Bank on Yourself to your financial plan, request your free, no-obligation analysis today at bankonyourself.com. Just click the Request Your Analysis button. Let's look at the fourth reason to be wary of an indexed universal life policy, the death benefit. The death benefit of an EIUL policy, like the premium, is flexible. The death benefit is not guaranteed, unless you have a no-lapse guarantee. If you have that guarantee, it simply means you'll have a death benefit, but it doesn't guarantee you'll have any cash value if the index performance is poor or if costs go up or both. And with no cash value to fall back on, you'll have to continue to pay premiums out of your pocket to keep the death benefit in force. Agents promoting this product don't usually mention that either. If you miss or delay making premium payments or loan repayments, that can reduce how long your death benefit guarantee stays in effect, and it can even void the guarantee altogether. And think about this. In an EIUL policy, there's no option to turn the policy into one which is fully paid up with no more premiums due. This means that depending on many factors outside your control, you may have to continue paying premiums out of your pocket for the rest of your life to keep the policy in force. But the premium for a Bank on Yourself policy is guaranteed never to increase, and the policy has a specified year after which no more premiums are due. And you always have the option of taking the policy paid up with no more premiums due anytime after the 7th year. Then there's risk, the fifth reason to be wary of EIUL. Indexed universal life policies shift all the burden and risk of managing the policy from the insurance company to you, the policy owner. The insurance company gets its money, but you don't necessarily get yours. You might very well find yourself having to pay skyrocketing premiums just to keep the policy from lapsing, or risk losing everything you've paid into the policy over the years. Compare that with a Bank on Yourself whole life policy, where your costs, premium, cash value, and death benefit are all guaranteed and predetermined. So why would anyone even consider buying an indexed universal life policy? Because you've been told that the return might exceed the return of a whole life policy. Do you really need another hope and pray strategy in your financial plan? The sixth risk you take on with an indexed universal life policy is policy loan risk. Agents trying to sell you one of these policies like to tout a loan feature available in some policies that might allow you to make money by taking a policy loan. For example, the illustration may show a 6% loan interest rate and an 8% annual return. That sounds pretty good. It means that, in theory anyhow, you could have a 2% gain on the amount you borrowed. So why not just get yourself one of those policies, borrow every dime you can at 6%, and earn 8% on the same money? There's just one problem with that. In most EIUL policies, every year there's no gain in the stock market index. There's little or no credit to your policy. Meanwhile, the costs are continuing to be taken out. And now you have a recipe for disaster. Since one of the most popular and valuable features of the Bank on Yourself method is the process of using your cash values to finance things, can you see why using an EIUL policy for this purpose can be so dangerous to your wealth? Go to bankonyourself.com/consumer-guide to learn how Bank on Yourself whole life insurance policy loans work. You'll discover that Bank on Yourself policy loans have none of these downsides. The seventh reason to be wary of EIUL is those pesky lawsuits. Why would anyone want to buy a policy that has as many pitfalls as equity-indexed universal life? I suspect it's because we all want to believe there's a magic pill answer to the volatility of the stock market. And until you dig deep, EIUL appears to have it all. But there are no magic pills. And isn't it time for all of us to stop the endless, fruitless search for them? The EIUL lawsuits have already begun. One lawsuit claims that, quote, any policyholder who purchases one of these policies is in a precarious situation, unquote, and that the slick EIUL marketing brochures, quote, conceal material risks that the policies will not perform as illustrated, but will instead lapse by projecting non-guaranteed values based only on index crediting scenarios that assume essentially constant rates of return, although the company knows the rates of return will be highly variable, unquote. The lawsuit argues that, quote, the guaranteed values used in the illustration are misrepresented as annual guarantees, when in fact they're calculated upon policy termination on the basis of average annual guarantees, unquote. The lawsuit also asserts that, quote, the costs significantly diminish the accumulation of value in the policies regardless of whether the projected gains are realized, unquote. So, for these 7 reasons, when it comes to EIUL, buyer beware. Bank on Yourself type whole life plans come with more guarantees than any other life insurance product, and they've stood the test of time, not just for 15 years or 50 years, but for more than 160 years. Whole life insurance is the only form of life insurance recommended for the Bank on Yourself concept. With a Bank on Yourself type policy, if the market is flat or down in some years, your cash value and death benefit won't go down, and market fluctuations will not put your policy at risk if you're taking policy loans to become your own source of financing. Who takes all the risks with an EIUL policy? You do. With a whole life policy, who takes all the risks? The insurance company does. And the companies recommended by the Bank on Yourself authorized advisors have under-promised and over-delivered results for more than a century. With a Bank on Yourself type whole life insurance policy, your premium is fixed and can never increase. Your costs are guaranteed, and the company cannot increase them for any reason. Your cash value is guaranteed to grow each and every year, and your death benefit is also guaranteed. At Bank on Yourself, we know there's no reason whatsoever for you to have to take unnecessary risks with your money. If you want a financial future based on guarantees rather than hope and prayers and keeping your fingers crossed, you'll want to talk with a Bank on Yourself authorized advisor to find out what your bottom line guaranteed numbers and results would be. To request a free no-obligation analysis and receive a referral to an authorized advisor who's specially trained in designing the supercharged dividend-paying whole life insurance policies Bank on Yourself relies on, go to bankonyourself.com and click the Request Your Free Analysis button. That's bankonyourself.com and click the Request Your Free Analysis button.